Guess now. Thanks, everybody.
Well, good morning, everyone. Oregon Realtors and everyone else who joined us this morning for a very informative discussion from three of the most knowledgeable economists and industry specialists we know. Drew and I are happy to bring our morning missives today addressing the economy, boom or bust. Drew, what do you think is going to be the most important content our attendees learn today from our three presenters?
Well, I just think it's always great to be able to hear from people whose job it is to know this. I think, whenever there's fear and there's articles that you can find online that can convince you of anything one way or another right now. But I think hearing from people who have studied the numbers don't lie, is going to be fun. And I do have one quick, very, very important graph that I'd like to show to lead it off. Can I do that, Jenny, really quickly before we get
to it? And Drew, for those who don't know, I'm Jenny Fakula, the CEO for your Oregon Realtors, and Drew is our 2020 OAR president-elect.
That's right. So here's a quick, just a quick graph that I think really shows well what's happening during this coronavirus trouble that we're having and the importance of different items. And you can see that coffee has maintained its importance throughout this stay-at-home quarantine order. Cars have become much, much less important. The internet, thank goodness we have Zoom. I saw that the founder of Zoom has made $3 billion since this started. Shaving, as you can tell from my beard, has gone way, way down. The need for alcohol seems to have been through the roof off the graph. Toilet paper seems to have abated, and sweatpants, really, I think being a sweatpants manufacturer right now is exactly the place you want to be. I don't think that's probably as hard hitting as what we're going to be seeing from Dr. Yoon and Dr. Connerly and Mr. Blanton, but I just wanted to lead us off with that. So let's get directly to our stars of the show. Jenny, is that okay?
Yes, that would be great. Thank you, Drew. I have the honor and privilege to introduce to you all Dr. Lawrence Yoon. Dr. Yoon is Chief Economist and Senior Vice President of Research at the National Association of Realtors. He oversees and is responsible for a wide range of research activity for the association, including NAR's existing home sales statistics, affordability index, and home buyers and sellers profile report. He regularly provides commentary on real estate market trends for its 1.4 million realtors. Dr. Yoon creates NAR's forecasts and participates in many economic forecasting panels, among them the Blue Chip Council and the Wall Street Journal Forecasting Survey. He also participates in the Industrial Economists discussion group at the Joint Center for Housing Studies at Harvard University. He appears regularly on financial news outlets, is a frequent speaker at real estate conferences throughout the US, and has testified before Congress. Dr. Yoon has also appeared as a guest on C-SPAN's Washington Journal. Dr. Yoon received his undergraduate degree from Purdue and earned his PhD from the University of Maryland. I know for our members, Dr. Yoon, you need no introduction. So we look forward to hearing from you and learning what's going to happen to this market when we can resurface again. So please take it away.
All right, great. So let me put the share screen. I have a few PowerPoint to share with the group. So hello, Oregon. And let me put it in the right mode. All right, so I believe that you can see the PowerPoint on the chart. We are certainly in an uncertain times, interesting, unprecedented conditions. Today, this morning, I did have a press conference with the reporters about the latest housing statistics, which in March declined from the February levels. On a year-over-year basis, it was actually almost even on a year-over-year basis. But also, we do anticipate that in the April-May period, the sales will be down notably. And the question is why? Is it because people are filing for unemployment insurance? The GDP forecast for the second quarter is off the chart, something like minus 30% annualized contraction. But this is due to the government-imposed lockdown. I mean, it is not due to the normal economic cycle. Government, in essence, said we have to shut it down. So economy shut down, and we will get some negative figures on some of the activity. Home prices are still rising, which is implying that if a listing shows up, especially at the mid-price or below, there is a tremendous interest in that property. Naturally, buyers want to see more inventory to be more excited about the market condition. But mortgage rate at 3%, historically low condition. So there's various conflicting forces at work. So let me quickly try to summarize how I see things play out. First, the economy and the housing market was in a very good shape up to February. It's really the March from the coronavirus and the subsequent economic lockdown that really led to the slowdown and the anticipated slowdown. It will be temporary. People who are getting unemployed, they are getting an enhanced unemployment insurance benefit. I believe it is more than $1,000 per week. So on a per week basis, should cover most of the income lost during the normal economic activity. So it's a sizable stimulus coming into the market. And Oregon was in a very good shape with a sizable job gains, one of the better performing markets in the country. If you look back 2008, Oregon actually was the worst performing with 12% unemployment rate. And people wonder what's going to happen. Is Oregon or Portland, Oregon going to turn into something like Detroit? Well, what do you know? It has become a technology hub, one of the fastest growing job market in the country. And every realtors will say they were just sold out on inventory. If inventory came onto the market, multiple bid process. So that was the pre-pandemic case. This is the number of people who are filing for unemployment insurance in the state of Oregon. So you can see that prior to mid-March, very low level of activity and then sudden surge that occurred in the past 4 weeks. We are monitoring it very closely to see when this will begin to stop growing. Also remember, once the economy reopens, there will be certain businesses that will be up and running full speed. Hair salons, daycare centers, dental offices. So some sectors which shut down because government imposed it, once it opens, it's going to be up and running full time. Restaurants, it may take a little time, takeout business is good, but sit down restaurant activity may take some time. Cruise ship, airline business certainly will take a long time to recover. But nonetheless, just because you see the surge in unemployment does not mean that all these people will remain unemployed for a long time. Many businesses will simply get back online quite quickly as the government, in essence, is permitting the businesses to reopen. Housing market, I mentioned, was on a very healthy ground. This is a long-term chart nationwide. So after the disasters of 2008, 2009, steady climb. One question that I get from the reporters and also from our members, should we anticipate something similar to 08 and 09? Well, one never knows how things will develop in the future, so people can make prognosis, but we still have to understand some of the factual information. And the facts are that back in 08 and 09, we had all those prevalent subprime funny mortgages, people overstretching their budget. This time around, before the pandemic, people had to qualify with sound credit, stay within budget. So the mortgage situation was completely different. Second big difference, back in 08, 09, home builders went wild. They overproduced, producing much more homes than historical average. Today, home builders have been underproducing, which is the reason why there was inventory shortage in the state of Oregon throughout pre-pandemic. During the pandemic, there's even fewer listings. I mean, there are fewer buyers, but even fewer listings. So in that sense, you can say, housing shortage is continuing today. We certainly don't have an oversupply. We don't expect mortgages to blow up, but we could have some mortgage forbearance, which government is permitting, but that will limit some of the foreclosure. But once people are back on job, maybe they make up for some of the missed mortgage payments quickly. Inventory of homes, I mentioned very low. So this is a historical chart, just the raw numbers. If people were to adjust this in relation to population, it will be even lower because we have a growing population in the US. So even the same number of inventory would imply we are insufficient. So very low inventory conditions before the pandemic and even lower inventory during the pandemic. Federal Reserve went all in. Back in 08 and 09, it took Federal Reserve 8 months to reduce interest rate back to zero, Fed funds rate, something called the bank borrowing rate, which eventually impacts the mortgage rate. But this time around, the Federal Reserve went all in all at once. So rather than trying to stretch it out over 8 months, they decided to go all in all at once. And therefore, the mortgage rates are at historic low of 3.3%. And I think it could even go lower. And here's why. The red line is the 10-year Treasury yield, and the blue line is the 30-year fixed rate mortgage. And both move almost in sync. What has happened in the latest month is that 10-year Treasury went down more than the mortgage rates. So if we look at the historical gap, there is a room for mortgage rate to go down to 2.7% or 2.8%. Now, I know that for non-conforming mortgages like jumbo mortgages, it has become even more difficult because some of the mortgage servicers are running into cash crunch. As people who have lost job recently, they're taking on that mortgage forbearance, so they're not paying their mortgages, but mortgage servicers still need to pay property tax, they need to pay homeowner insurance, and also they need to pay mortgage payment to the investors. So if they're getting cash crunch, they are saying for any non-government backed mortgages, they are very hesitant to provide. So right now, the mortgages that are in the game are mortgages that can be sold off to Fannie and Freddie or FHA mortgages. But there is a room for mortgage rate to go down, even though non-conforming mortgages have become much more difficult. Homeowners are sitting on a sizable wealth. Green is the total US real estate valuation according to the Federal Reserve. The red is the mortgage balance outstanding. So you see the gap opening up. So gap represent homeowners' wealth. So even in the possibility of a price decline of say 5 or 10%, which I don't foresee because we are in an inventory shortage situation. But let's assume the worst and prices were to decline 5 or 10%. Homeowners can easily absorb some of the price decline. I mean, in Portland, just think of how much price appreciation in the past 3 years. So if there was to be even 5% price correction, there is such sizable equity, it does not put people in underwater situation for the most part. So it's in a very healthy situation for the homeowners. I don't believe we will see any large price decline. I think prices will hold on throughout the pandemic because the listings are few. And the lack of buyer interest is they're just complying with stay in shelter orders. Once the economy reopens, they will be going back into the market. I know that people are unemployed, but even in the worst case, 70% of the people have secure employment and they are looking at 3% mortgage rates. And with inventory being so low, and as economy reopens, I think there will be a surge of inventory coming onto the market. And most of those inventory listings are also, I mean, their buyers also, they're selling in order to buy, trade up and whatnot. So expect this decline in sales activity next couple of months to be only temporary. Inventories are short because housing start, new home construction activity for multiple years has been very low. And that's why we have this inventory shortage. Again, no oversupply situation. And this has a lot of numbers here. But quickly, what this chart is trying to say is, even though home prices are high, believe it or not, it is more affordable because of historically low mortgage rates. Back in the year 2000, mortgage rates averaged 8%. Also, you look at the chart and you say population is higher, household formation is higher, number of families is higher, or at least pre-pandemic, the number of jobs were higher. So if we compare 2000 to recently completed year of 2019, home sales were actually lower, which means something is misaligned. If we had better affordability, more people, more jobs, why was home sales lower? So this shows that there is a pent-up housing demand. We just needed more inventory to satisfy all this pent-up housing demand in the pipeline. We have to go over the pandemic. So during the pandemic, very unusual numbers of home sales down measurably. But once the economy reopens, I expect that many of the unemployed people will return to their jobs. Some industry, maybe not, but I think a good number of industry will be fully up and running part. So coronavirus impact, we decided to take survey of realtors about their home buyers and home sellers who have clients in either buying side or seller side. A lot of numbers here, but what in essence shows is that home sellers are not panicking. They're saying, I listed the property, I'm going to maintain my property. So whatever the market valuation said, I'm going to keep it at that price. They're not cutting prices. Buyers, they don't anticipate reduction in price. Majority believe either same price as pre-pandemic or maybe up to 5% lower, which means that even in a normal market, buyers always want to offer a little bit less than the listing price. So vast majority of consumers out there are saying they don't anticipate price decline, or they're not going to lowball an offer thinking that they could get a home. So only way to get a home is you have to offer a proper price that was almost pre-pandemic price. And the stimulus help, so the unemployment insurance I mentioned, very enhanced, $600 from the federal government. Realtors do qualify. Even the state of Oregon may not have the computer system ready. So once it is up and running, it should be retroactive. So whatever weeks you are missing out on, you should be able to fully get that amount. And also mortgage forbearance. So that will limit foreclosures until people return back to the job. And also the federal government or Federal Reserve doing quantitative easing, meaning they're buying mortgages to assure mortgage rates will remain low during the pandemic. And also mortgage rate remains low after the pandemic. And so overall, my forecast is that the economy, we had a few months of pause button. So overall GDP will be slightly negative. Some industry will not come back, like the cruise ship and airline. Therefore, there will be total net job losses in 2020. Home prices remaining relatively stable. We are missing out on the spring buying season. So we will catch up some sales later in the year, but some families want to move in the spring or in the summer. If they cannot do so, then they're gonna wait another year. And the reasoning is they have a school-age kid, they don't wanna disrupt the school year. So they said, well, if I cannot get in by August, I'm gonna might as well wait another year. So we're gonna be a little light on home sales, but again, home prices would be holding steady. But next year, positive, positive, positive. Home sales, home prices, economy are all turning positive. So we just hit a pause button, and there's really no way to make up for that pause button for 2-3 months. So that is my outlook, and thank you for allowing me to participate in this event.
Well, thank you, Dr. Yun. It was so nice to end on a really positive note, because it seems that everything has been so doom and gloom since this started. So that was very, very encouraging, and your insight is always appreciated by our members. I know there are a lot of questions coming in. We will do our best. We have 2 other panelists to get to, and we will make sure you all get the slides. So I don't know if Katie, they were sent with a link, but if not, I assure you they will be sent today. So Drew.
Yeah, it sounds like Dr. Yun has spoken about the economy once or twice before. What do you think, Jenny?
I'm thinking, yeah, he's pretty experienced. He knows what he's doing. And the nice thing is I don't know if it was spin or not, but it was a great positive presentation in spite of what's going on. So thank you, Dr. Yun.
Well, I think it's just the data. And before we get to our other panelists, Dr. Yun, we do have a few questions for you that have come up in the chat, if you don't mind me asking. One person commented, and maybe you can opine on this as well. They said, looking at the 09, 010, it looked like the stimulus package did make a difference there, looking graphically at your slides.
So the stimulus package back then, it was of a largest of its kind at that time, but today, compared to today's stimulus, it looks very light back then. Think about the unemployment insurance. People who are losing job at a retail sector, they were making about $900 per week. But if the data that I'm getting is correct, which is saying about $1,000 per week unemployment insurance, there could be some people who are actually getting a little more in unemployment insurance currently than before. People working in leisure hospitality, like working at a hotel, they are making about $700 per week. So again, if people are getting laid off, they could be slightly better off. Not to say that there will be many people like that. I think for most people, they will be worse off. They want that job back situation, but it's quite a enhanced stimulus package. Other thing to be mindful is I like to look at the example of New Orleans Hurricane Katrina, because Katrina impacted all the retail, leisure, hospitality business went away. Unemployment rate shot up from 5% to 15% in a single month. Large disaster relief money went into New Orleans, and home prices actually rose in New Orleans the subsequent 2 years. So there's nothing to imply. Same thing for 9/11, terrible events of September 11th. New York home prices actually rose the following couple of years. Of course, we cannot compare those situations completely with today's situation, but if there's some level of comparison to say that with so much stimulus money in, hopefully this is sufficient so that economy can come back almost back to normal once governors say back to normal.
Well, what's $1 trillion between friends, Lawrence, anyway, you know? It's really nothing. One other question we had is the numbers you were showing for total assets, were those Portland market only, Oregon only, or were those US numbers?
Those were US numbers, and for Portland, it will be even higher. Portland, Seattle, those were two markets with exceptional price increases past 5 years.
Wonderful.
Great. Okay. Thank you, Dr. Yoon. Drew, should we carry on and introduce the next panelist?
I think we should. Yeah, shall I go first or would you like to?
Yep. Take it away.
Perfect. All right. I am going to unmute our friends, Dr. Bill Connerly and Noah Blanton. And so first, let me introduce Noah Blanton. A lot of you here in the Portland metro area definitely know Noah already. Noah is the president of WFG National Title's Portland Metro Direct Operations. He's been in the settlement services industry for 22 years, managing operations for Washington, Oregon, Nevada, and National Title Insurance underwriters. He speaks a lot, frequently, on real estate markets, focusing on hyperlocal trends and consumer behavior with an emphasis on practical application for real estate professionals. He served on the boards of Clark County, Portland Realtors, OREF, and holds an MBA in real estate finance. So Noah, welcome to our program. Thanks for joining us.
Good morning. Good to be here.
And then we've got one more panelist that'll be joining us, Jenny.
Okay, thank you. For all Oregonians who love to follow the economy, Dr. Bill Connerly is no stranger to you. Dr. Connerly is an Oregon economist with a global reputation. He is a senior contributor to Forbes with the Duke University PhD. As a consultant, he connects the dots between the economy and business. He is also the longest serving member of the Governor's Council of Economic Advisors. Companies have used Dr. Connerly's expertise to help with decisions regarding capital expenditures, inventory levels, expansion into new markets, pricing, business models, and financial structure. Dr. Connerly has spoken to over 1,300 business audiences in 5 countries and 31 states. He's written numerous articles. He is definitely well qualified, and I could go on and on with his bio, but we'll take it away, Dr. Connerly and Noah. Drew, do you want to, how do we want to start this? Do you want to ask some questions or let them do their presentations?
We've got Dr. Connerly on the screen. So Bill, why don't you share a little bit with us? What are your feelings on the Oregon economy looking forward? Are you bearish, bullish?
You know, I'm positive. I'm not sure how positive I want to be, though. If you are focusing on the doom and gloom that we've seen in the media, then yeah, I'm really a wild optimist. When you look at the details, I don't feel wildly optimistic. A couple of things I think are significant. First of all, Oregon is looking a lot like the rest of the country. If you look at where the unemployed people are coming from, it's the usual sectors, you know, restaurants and hotels. A surprisingly large number of people in healthcare are now unemployed, which surprised us at first, but then we said, oh, elective surgeries are not happening. So the surgery center that does cataracts and hip replacements, that's closed. My dentist's office is closed except for emergencies. And we have seen this permeate basically every sector of the economy has had a surprisingly high level of unemployment now. So, but in that regard, we look a lot like the rest of the country. And when you think about who are home buyers, I would emphasize a wide variety of people there. We often tend to put people into a category. and make a generalization like, okay, a waiter is not a typical home buyer, but the waiter may have a second income that enables the family to be home buyers. And without that job, the family doesn't qualify. So we are going to lose some potential home buyers here. The second point I think that's worth mentioning is that we are not going to get a sudden all clear. Instead, we're going to reopen gradually in a phased way. The White House has issued some guidelines, and they look very, very similar to Governor Kate Brown's guidelines for Oregon reopening. Maybe the first time that Donald Trump and Kate Brown have come up with the same idea about anything at all. But we are going to I'm sorry?
We can be positive about something.
Yeah, right. We're united. They're uniting the country again. But we are going to have a gradual reopening, and the governor's guideline says we're going to look at the data. And that's the third point I wanted to make is I'm looking at, when I look at Oregon data, like Dr. Yoon said, the March data isn't that important. And when you see a big change, when we go from 4,000 unemployment insurance claims to 63, 4,000 to 63, I don't need to look at the details. Is it 63 or 63.1 or 62.5? It's a big, I was about to say a bad word, a big difference. So what I'm focusing on when I think about the outlook is the epidemiology. So every day I'm tracking our new cases, new hospitalizations, deaths, and it appears to me, not an epidemiologist, but a guy who's looked at numbers for many years, it appears to me that we're past the worst of it, but that there is still a good bit of the virus in the community. And so I think what we'll do is in a few weeks, do a partial opening, and the governor's framework, I actually kind of like it. Do a partial reopening and then wait 14 days and see what the cases look like, and then do another phase. So this will be a gradual process, not a sudden all clear. But I do agree that Oregon is going to look a lot better in a few months.
That's good. I know that my hair transplant surgery was postponed, which has really been very, I know a lot of those medical professionals. Noah, you've got a good head of hair.
I think that's an essential service, Drew, looking at your picture there.
Yes,
Well, I have the opposite problem, Drew. I desperately need a haircut.
well, you and a lot of people. So Noah, what are you seeing? You here work in Portland Metro. Jenny, what were you going to say?
Oh, no, nothing. I mean, as soon as the economy opens, when do you think, let's assume we got through phase one, things look good after 14 days. Then we go to phase two, things look great, no new cases. What is your projection for when we'll really fully reopen and our Oregonians can resume some normalcy and restaurants will be full again and we can go to the beach and stay at hotels and enjoy ourselves? At what point, if all goes well, when do you think that will happen?
I personally think that waits until we get a vaccine or a really effective treatment next year. So I think the rest of this year will be, I think we'll recover 60% of what we've lost fairly quickly. And then we'll be edging gradually towards 80 or 90%, but we're not going to be 100% reopened until we get a vaccine. That's that's a political opinion and an epidemiological opinion for which I'm not really trained, but that's what looks like to me.
Gotcha. Noah, what are your opinions on how that'll look? And also, are you bearish, bullish on the local economy? How are you feeling?
Well, this may very well be the greatest day of my life because many of my own slides actually agree with Dr. Yoon's, and so we did not coordinate that. So, Drew, is it okay if I share my screen and show some slides?
Please do. I love slides.
Okay, me too. So let me see. Can you see those slides on the screen?
Coming.
Not quite yet. Yes, now we can.
Okay. Let me see if I can make those a little bit bigger. And I'm going to skip some of these, but can you see them now?
Mm-hmm.
Okay.
Yeah.
Okay. So this sort of is exactly what Dr. Yoon was talking about, weekly initial unemployment claims in the state of Oregon. And I think to Dr. Connolly's point as well, does it matter if it's 50,000 or 100 or 200,000 at this point? The scope is so dramatic. And this shows weekly unemployment claims and then the shutdown order. And you can see the dramatic rise there. But what I would point out is, and we see this in a couple of different areas that I think is important, that you see the initial weekly claims beginning a decline. Now, is it still 93,000, 78,000? Yes. Is that still catastrophic? Yes. But we begin to see some decline in those weekly initial claims as maybe we begin to see evidence that we're moving through different sectors. And I think that's probably positive. As a visualization, the week of March 8th, the unemployment department had 106 staff processing. As of April 10th, had 450. And so they're working hard to get through those claims and get people on the rolls and paid, which I think is positive. Bill had alluded earlier, this is sort of a visualization in the whole state of by size, where we're losing jobs, who is becoming unemployed. Not surprising, certainly accommodation and food services, but a little surprising until you think about it, healthcare and social assistance. Retail trade, not surprising. And so then I think you can begin to put some structure to, well, how do we bounce back? And there's a behavioral element to this. Drew, you and I had talked the other day about sort of projecting, well, even if a restaurant was open, how many people will go back to that restaurant? Is it 50%? Is it 30%? And there's a behavioral element that is unknown. We're in recession due to a pandemic, but because of government fiat. It's recession by government fiat, rightly, in order to contain a pandemic. But I don't know that we've experienced something quite like that. And it's interesting by county if you want to drill down into these numbers and get an idea for how your particular county looks. And there are resources to do that. This one's kind of hard to see, but this is just the workforce in the MSA, the Portland MSA. It's 2,000 on the left and through the first quarter, or the latest BLS numbers on the right. And the top is the total labor force. And then the darker lines are the total number of employed. So the green line then is the fraction that comes up with unemployment. And as Dr. Yoon had said, Oregon had just incredible, unprecedented job growth. We had taken a little bit of a pause and then began again sort of to grow jobs at a really wonderful pace. You can't see it, and so I'll zoom in a second, but I like to visually get an idea for kind of what the current damage, if you will, looks like in the metro area. But we were pushing, during this period of time, pre-recessionary levels of the percent of the prime population that was employed. I mean, we were really pushing at the top of an incredibly healthy labor market. If you zoom in to just a few months now, you can see sort of the projected job losses and what that means for an implied unemployment rate, and about a 73% increase in the total number of unemployed. This is just the metro area. So you start to put some structure, over and over again, the question that we're asked, in our business is for buyers and sellers. How should they be acting in this market? And so I think the more sort of structure you can put, the more that matters. Weekly data, I think, matters disproportionately right now. We don't have quarterly data or even really good monthly data. It's hard to come by that. And the data is so vast, it can become difficult. But I found this to be an interesting measure that anyone can do in any market. And this is the percent change from the prior year to date in listed properties, pending properties, and cancellations. 0% change is here at the midline. And so this is comparing these same weeks to this time last year. You see listeds kind of trailing along there, pendings trailing along. And you see the market buyers and sellers start to react here. You get an 80% reduction or so, 78% reduction in listed properties as people paused and said, hey, what are we going to do here? Pending sales drop. That's not surprising as people absorb a stay-at-home order and sort of come to grips with the sort of surreal nature of what we're dealing with. Properties delisted, we saw that nationally as well as cancellations went up and people said, no, I'm either not going to complete this purchase or I'm going to pull my property off the market. But then you see in the next 2 weeks, as those trends begin to reverse themselves. And I have said this a number of times, I believe this is a little bit like a holiday market where only very serious buyers and sellers are engaged in the market. All those that the market didn't meet their demand withdrew quickly from the market or made decisions about what they were going to do. I think this is a very positive sign for the real estate market. And fortunately, as Dr. Yoon said, supply is down while demand is down in the short term. There was no glut of inventory coming into this. Any of you that have heard me speak before have probably seen this slide, and it's a demand indicator. And it's just an absorption rate. So it's of however many listings are put into the market in a given year, how many of them are absorbed. So if 100 listings were in the market in 2016, 82 of them sold. That's all this is. And then overlaid with the average sales price in the Portland metro area. We had and have an incredibly stable amount of demand in our market, well beyond any precedent in the recent past at 70 to 80%. We began a very orderly descent in this last cycle, but our absorption rate actually ticked up last year at the end of the year. And absorption, and I know that the first quarter is probably not a good indicator of where we're at, but it is a good indicator of what comes next. Absorption at 77% in the first quarter. We have a very healthy real estate market in balance, and as Dr. Yoon said, probably a looming inventory issue. Same sort of area that we're looking at, but what I want to call out here is the fundamental difference in our market today versus the market pre-recession in the last market. This is building permits by total units, not by building permit in the Portland metro area. The blue lines are single family, the orange is multifamily, and then the line is the percent that's multifamily. We have not built anything on the single family residential that would be a historical precedent, even though we've added 250,000 jobs and about as many people. I think you can sort of see an inventory issue that still exists. We have lots of multifamily, yes, and we have lots of full multifamily, but Oregon, Washington, and Nevada had been historically underbuilding single family residential, and I'm almost done here. But this expands on an idea that Dr. Yoon had talked about, and this is 30-year mortgage rates, 10-year T-bills, and then the average spread. The average spread is that gray line down here. If we take the spread at average, this just sort of verifies visually what Dr. Yoon had said. There is room for mortgage rates to move downwards into the 2.7-ish range at the moment. And coming out of this in recession, if rates go even lower, we may well see widespread sub 3% mortgage rates. Good news on the outside. And then I have found it helpful as we sort of try to put structure and help buyers and sellers think about what a recovery might look like. And Dr. Connerly was quoted actually in the blog post that this came out of the Oregon Office of Economic Analysis. And it's this idea of a square root recovery, sort of putting structure to what Dr. Connerly had said, that initial bounce back. Is it 20%? Is it 30%? Is it 50%? And then duration being the great unknown, right? How long does it take to get back to 100%? And in what phases and in what sectors? So, you know, obviously an evolving situation, but I think this puts a little bit of visual structure and helps us understand how to talk to to buyers and sellers. So just supporting information at the local market. But I think we have a looming inventory problem coming out of this, as you've watched supply and demand from an inventory perspective sort of come quickly into equilibrium in the local markets.
So you think the supply and demand situation will be worse than it was before the pandemic hit our market?
I think it has the potential to do that and push prices up as we come out, especially depending on how builders decide to engage with this. You know, we have an issue with permitting. We're going to have a backlog coming out. Depending on how long we pause, we may have inventory that goes stale and cannot come to the market. And I think you see sellers in a materially different position who have options, who are saying, hey, if the market doesn't meet my expectation, I'm going to withdraw from the market. And we saw that happen very quickly. And we see prices holding very stable at the moment. So it's just materially different than the last go around.
Yeah. So Drew, there's a lot of questions that have come in from our listeners.
Yeah.
So perhaps you could ask the panelists some of those. We only have Dr. Yoon for a few more minutes. He has to move on to the next state to assist with their members. So take it away.
Absolutely. Well, let's ask just the ones I see here at the bottom, and we'll kind of go rapid fire hot potato with Dr. Yoon, Dr. Connerly, and Noah. Is there what do you think will happen to rents in college university towns, Dr. Yoon?
Well, you know, with the rent situation where is permitting, again, government policy during the pandemic period, where eviction is not allowed on the Fannie and Freddie back apartment buildings. It's an interesting dynamic, but just in terms of the housing shortage that we reference, it's not only about the owner occupancy shortage, the apartment vacancy rates were running low. So it's a tremendous housing shortage all across. But during the economic recession, however short or however long it is, there is a tendency to double up. And hence that reduces some of the housing demand, even though people don't have the elbow room. Another development, I think, is after all clear signal is given, I think some people may say their house really does not fit into this more possibility of working remotely, less commuting time and things like this. So maybe not this year, but say 2-3 years down the road, people who are content with their house are suddenly discontent, and that may lead to even more home sales in future years.
Got it. So one quick question is, it used to be that 6 months, Dr. Yoon, was an equilibrium market, that was kind of a balanced market between buyer and sellers. Well, how many months of inventory is a balanced market today?
So I would say it's a little lower, maybe 5 months could be even that. 6 months was considered normal because that's when prices neither increase nor decrease. But now with the internet search availability that people can do more quickly, so it could be a little lower. Today's data shows is 3 months, 3.5 months supply. So still very tight conditions.
Wonderful. Jenny, do you have any other questions you want to fire away here?
Well, I mean, I was going to do an overall one for all the panelists, but particularly Dr. Connerly and Noah. So I can hold off until Dr. Yoon moves on, so that we can get to as many questions that might be applicable to Dr. Yoon specifically. And since you're monitoring the chat, I will leave that discretion up to you, Drew.
Sounds good. So one other question, Dr. Yoon, is there any harm? Are there any unintended consequences from interest rates going down so low? Is there a national economic effect long-term from having rates that low?
So this is my last question because I have to go to Kentucky right after this in a minute.
There you go.
But the technology allows me to go from Oregon to Kentucky just at a snap of the finger. So the low interest rate, I mean, certainly good for refinancing. Homeowners are benefiting. It does make it more affordable for people sort of on the margin. But one future consequence is that people may decide to hold on to their locked in at their low interest rate for a long time. So it may hinder mobility in future years. One final comment is massive stimulus is coming at essentially by printing money to provide their funding. But the printing money, economics would say, leads to higher inflation. US is fortunate to have the US dollar, which keeps the inflation in check. But say 5 or 6 years down the road, we have a little higher than normal inflation of say 4% or 5% rather than 2%. What is a good inflation hedge? Well, gold could be a good inflation hedge, but also real estate is also a good inflation hedge. So if inflation perks up slightly in the future years, real estate always keeps value in relation to inflation.
Wonderful.
So with that, thank you, Oregon, for having me. I'm going to have to sign off now. So thank you.
Thank you, Dr. Yoon. We'll see you again soon.
Perfect. Well, let's talk about forbearance a little bit, Jenny. Dr. Connerly, is it a good idea for someone who's having, uncertain about the future with their economic status to go talk to their mortgage company about forbearance? And what does forbearance actually mean?
I'm not the expert on that at all, and I'd want to learn more before I expressed an opinion there.
Wonderful. Well, let's talk a little bit more about how you see the economy coming back. We've had a lot of questions on the chat about, hey, I'm in a second home market, I'm in Bend, or I'm at the coast.
Yeah.
How will the recovery affect those areas versus perhaps Portland, Salem, Eugene?
Yeah, I think it's worth thinking about migration into Oregon and into the different parts of Oregon. Last year, 2019, we added 41,000 people to Oregon's population. Of that 41,000, 35,000 were in-migrants rather than babies. So the millennials are being a little slow to have children, which is their choice, but of course, none of them are getting any younger. I'd point out to any millennials in the audience. But we are a state whose population growth is driven by people moving in, net of people moving out. And in a recession, people tend to move less often. And I think this recession is going to be a little different in that people will be even less likely to move for better opportunity. The social distancing makes moving a little bit harder. This would be good news for rural counties in Iowa that typically lose population, but for a state like Oregon that gains population, it's, I think, bad news. And it's going to be particularly, I think, negative for folks who are in the counties that benefit a lot from that. So Bend is a good example of a place that gets a lot of people moving in there, and I think there's going to be less move in, which means less boost for the housing market. The danger is for those folks who built new properties assuming that the growth would continue. And then if the growth is only half the pace that's expected, you've got excess inventory in that community. So that's something to worry about. And then something that was mentioned a moment ago, I think that when people look at a place to live, whether it be a house or an apartment, they're going to say, oh, I like some of this work from home stuff is good. Some people like it, some people don't, but the average commute round trip is about an hour. And if you say to somebody, oh, would you like to have a free hour of time? Maybe not every day, but a couple of times a week, that might very well motivate them to buy a house with an extra bedroom or at least a nook that would be a good work from home location.
That's a good point. We've talked, some of my real estate colleagues and I have joked about the need for his and her dens, what might be the newest must-have feature in homes going forward.
I was on a call yesterday and I asked one of the other participants if she could mute her husband. She said,
Drew,
if only.
That's nothing new in Drew's house. Pre-pandemic, we're saying that all the time for their spouses. I am curious, and this Noah and Dr. Connolly, so how are the states going to balance their budgets? What are we going to do? I mean, the lack of revenue that will or is not coming into the states. I mean, we still have to balance the budgets. What's Kate Brown going to do in the esteemed legislature down in Salem? We're going to cut programs, raise taxes.
I'm going to totally leave that one to Dr. Connerly and ask if I can go back when he's done and address the forbearance question.
Okay. The short answer to how we balance the budget is I don't know. I'm guessing that, and we say that we have to balance it. We can actually issue bonds. I think there will be some. I think most governors will be asking the federal government for help, and we'll probably be cutting programs as much as we can, and shifting people from one program to the other. The figures that I think was Noah showed about number of people processing unemployment insurance claims, those are, I'm guessing, people from other parts of the state that were shut down that were shifted over. So maybe instead of adding, we're just going to be shifting. And now I'd love to hear about forbearance.
Well, I know there has been a lot of sort of negative connotation around forbearance, but I would like to pose the question, what would you prefer, forbearance or foreclosure? And I think that the lenders learned a valuable skill set in the last recession, and that was working with borrowers to keep them in homes ultimately was the absolute best thing for them. And typically at the end of a forbearance, you have options. So they aren't all lump sum payments. You can pay it over a year. You maybe can add it to the end of your loan. And I have understood that forbearance, which would immediately put the property into foreclosure and ding credit, is now not going to do that for borrowers. There's 3 million loans in forbearance already, $100 billion of CMBS in forbearance. And so the question would be, well, what is the option? To foreclose on people and I mean, we have seen that movie before. That is where you then do get a glut of foreclosed or REO or distressed inventory. And while I understand it may not be option number one, I do think it's a viable option, and the way it's being instituted is different this time. And I think keeping people in their homes, again, this is not a normal recession. It is one where we expect a different type of recovery, and bounce back is positive. I'm pleased to see the forbearance numbers where they are, because your option is distressed homes and foreclosure. That's your only option.
Okay, so Noah, that's fair, but what's going to happen in 3 months, 6 months, a year when people have to pay it back? How are they going to really pay it back on top of paying what their current mortgage or current rent is?
Yeah, I think that depends on the method of payback. If it's add 3 months to the end of your loan, then they'll just resume making payments. If it's, landlords are going to have the same issue where they say, how do we recoup, the amount of money that we've lost? Maybe they will have some sort of modification or something else. And one of the things, I think this is so fast moving and evolving, and the amount of focus and willingness by, I think, the government and others to act indicates that we will likely get solutions to those questions. But I'll just go back again to, I don't know that we're solving problems for 3 or 6 or 9 months. I think we're solving them for 30 days. Because the amount of uncertainty makes it impossible for us to solve that issue for 6 months. And I think that's why that sort of square root recovery is interesting, because we'll get certainty on some things, but as Dr. Connerly said, it's not going to be boom, we're back. It's going to be something different. So it is difficult to answer those long-term questions. What we see, though, is a willingness by regulators and lenders to say we will do almost anything to avoid foreclosing on 3 or 5 or 7 or 10 million Americans.
Yeah, which is great in the short term, of course, like the launch of the PPP program, which the banks were caught really quickly having to adjust, and then the borrower, the consumer, is the one who suffers because there's not enough time. It's like shoot and then aim, right? And I know when you're in this kind of crisis, there's not many other options, but the long-term consequences are what is going to be a bit concerning.
It's triage at this point, addressing the most acute issue and then postponing other difficult issues for the long run.
And I know there's always the solution of the day. I remember during the last recession, it was the loan modification. And I mean, I think in thousands of people talking to, I saw 1 or 2 loan modifications actually go through. You wonder if forbearance is going to end up the same way. But I know Jenny has a wrap-up question. I have one as well, and we have so many great questions in our chat that unfortunately we're not going to be able to get to a lot of, but we'll try to get an answers and a Q&A out. But Dr. Connerly and then Noah, what are the 3 stats that a member should know going forward to be able to be educated and help their clients? What parts of the economy, what real estate statistics should they know to be a good service to the community?
I don't know that I'm going to give you 3. The first one, I think, is monitoring cases, COVID cases, and you can find that from the Oregon Health Authority, and Wikipedia has really done a great job of putting the data in one easy to look at place. And I would look at that, well, I do look at it on a daily basis. Most of the traditional economic statistics that people are looking at, employment, personal income, it takes a couple of months to process the information, so it's out of date. The weekly unemployment insurance claims, which are available online, those numbers are probably the most useful thing that we have in this fast changing environment. And then NOAA and WFG really pay close attention to the weekly sales numbers, and they do a good job on that. And that's another thing that I'd suggest looking. And really, I'm different because I'm an economist, but when I talk to a realtor, what I want is not so much the market statistics as the realtor's judgment of what's happening. Somebody who talks to potential sellers, talks to potential buyers regularly, and can give me a judgment about the mood in the neighborhood I'm looking at.
Great. Noah, same question. What statistics should our members know?
I think I would be looking at those weekly statistics and comparing them to something useful. I think people are craving structure and context in this market. Any structure you can give them is positive and good. So if you can say, look, compared to a year ago, this is where we're at in pendings, listeds, and canceled, I think that is relevant and timely information. I would look at absorption rates and inventory. I think you may very well see absorption go up and inventory go down without significantly more velocity during this period of time. I don't think you're going to have, sort of casual buyers and sellers engaged in the marketplace. So I think absorption rate, I think velocity certainly is important, because you can put those 2 things together and say we may very well be in a scarce market, even though we're in this period of time. And then depending on the price point, I would probably watch the change in average and median price pretty closely. I think most people have the question, is this going to depress prices? I don't think that it will. But I think if you can, a few stats there that you can give people and help them look at their market with structure and say, okay, I have an understanding of how this market's acting, and I can judge for myself whether this market meets my own goals.
So I say we end on a positive note. So what is the biggest cause for optimism right now for our members and the Oregonians in general?
Well, the real estate market is driven by people needing a place to live, and that fundamental has not changed. And whether it's 1 year, 2 years, or 3 years, at some point we're going to come back where that is the fundamental driver. And there's every reason to think that demand for housing will be even greater in Oregon when this is all over.
I would echo and agree with that and say that the greatest cause for positivity is the relative health and strength of both our economy and the housing market. Duration starts to matter, but I think we came into this in such a strong position, and I see us in the housing market specifically reacting so quickly and the market reacting quickly, I think there's great cause for optimism as we begin to cover and come out, both in the employment market and in the housing market. So the positive note is the high, in my opinion, strength of our housing market and economy. If the patient's going to take some treatment in the short term, their relative health going into it matters tremendously coming out. And we were quite strong going into it. I think that's very encouraging.
Good. Drew, what about you?
Well, I think housing was one of the challenges, and the last recession is what everyone remembers, right? And it was led by housing. Everyone remembers in The Big Short that the dancer of ill repute owned 5 houses that she had bought on interest-only notes, and that's not the fundamentals anymore. I think housing is incredibly strong. I think never at any time has home meant more to people, and are they reevaluating what home means than right now when I'm sitting at home, Jenny's sitting at home, Bill's sitting at home, Noah's the only guy in a Class A office building of 6,000 people. It's
Class C.
Class C, okay. I think home's really important. I think people are going to reevaluate and say, hey, this time with my family was great, and I can work from home more. And I think people are going to find their homes to be their safe haven, and I'm excited about that. And then the other thing, Jenny, was the thing that Charlie said last week on our panel, which was, it's hard to be depressed when you're helping someone else. And I know our Oregon are such helpers. So I would encourage everybody to go find one person that you can help. If everyone finds one person that they can do something good for, whether it's the person with some pre-existing conditions or someone who's maybe getting up in years, see if you can do something for someone else, and we'll all get through this a lot quicker.
Yep, that's great. And the one parting comment I want to make is that I can't wait for the restaurants to open again, because I'm telling you, takeout nachos don't cut it. They're not crispy, they're soggy. And yeah, I want to get back to my local neighborhood hunt and get extra crispy chicken nachos. So let's get moving here.
I'm with you, Jenny.
Yeah, thank you. Well, thank you to our panelists, and of course, my fabulous co-host, Drew Coleman. It was another great week of information, and I appreciate you all taking your time to attend, and this particularly our panelists, who are, I'm sure, very busy and in high demand right now. Drew, any parting comments?
No, thank you all. Be safe. We'll see you soon.
We'll see you soon.
Great chatting with you all.
Morning,
Thank you.
Signing off.
Bye-bye.
Okay.